Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with silverdoctors.com, and back with us today is Alasdair MacLeod from goldmoney.com. Alasdair, thank you so much for joining us today.
Thank you very much.
All right, now the first topic I'd like to discuss is the precious metal markets, because one of your colleagues at goldmoney.com recently wrote an article that talked about why silver seems to be its positioning for a breakout. Can you expand on, do you believe this, and can you expand on why?
Yes, I think you're referring to an article, I think, by Stephen Wheeler, and right. I would agree with his supposition. The precious metals, I think, as a whole, are on the verge of breakout. As far as silver is concerned, it has become very, very oversold. Now, this to me is a bit of a mystery as to why people should short silver and remain short of silver on the view that it's going lower. I can only think that this is hedge funds thinking that the global economy is going to nosedive and there is going to be diminishing demand for base metals, to which silver is probably more tied nowadays than gold, in this current environment anyway. However, I think it's only a matter of time before gold breaks out above the sort of, I suppose, this sort of trading range we've had recently, the upper end of which is around about $13.60, $13.65. Once we break out of that, I would expect silver to move like like grease lightning, if you like, because always it is, if you like, the poor man's money. It's the poor man's metallic money, as it were. The rich people go for gold all around the world. The people who can't afford gold, in inverted commas, go for silver. So the volatility, I think, historically has been a move in the price of silver equates to something just a little less than twice the move in gold. So if gold goes up 5%, silver goes up, say, 9%. That is the sort of the order of the move. And because I do expect gold to break out, I do expect after this current rally in the dollar for the dollar to weaken. I can see gold going quite a lot higher over the rest of this year. And under those circumstances, I think that silver would be a very, very good thing to own.
No, you're saying gold could go quite a lot higher. What exactly, do you have a price target?
No, I never ever have price targets because they're completely meaningless. Nobody knows what tomorrow's price will be. What we do know, however, are the dynamics behind the market. And at the moment, the dollar is strong, and that is leading to weak gold. This is because people buy a strong dollar by shorting gold. It's as simple as that. This is the business in the futures market. It's not the physical market. It's the futures market that puts this link into place. I would personally expect to see President Trump's economic policies begin to undermine the dollar later on this year. And I don't think it'll be very much later this year before this happens. Now, the reason that this is going to be the case is that you've got two drivers that you look at in terms of currency relationships. The one thing which is obvious and everybody talks about is interest rate differentials. And at the moment, the interest rates on US Treasuries are higher than they are on, if you like, the European government securities denominated in the euro. And in some cases, it's quite a lot higher. So you can see that is an attraction. That is an attraction for people to hold dollars relative to euros. But the other thing that is very important is the trade situation. Inevitably, the result of this increase in the budget deficit that President Trump is bringing about will lead to an increase in the trade deficit. And it doesn't matter what trade tariffs or anything else he puts in. It is, if you like, an accounting identity that is what happens. So what we will get is we will get evidence of a deteriorating trade, balance of trade for America. And I think at that stage, people will begin selling the dollar quite heavily. The other side of that, of course, is that if you want to short the dollar, you buy gold. If you take that one step further and you're worried about the outlook for the dollar because the Fed can't raise interest rates by very much without bringing the whole caboodle down because of this massive, massive quantity of debt overhanging everything, then you've really got the sort of stagflationary nightmare, if you like, whereby they can't raise the interest rates because it's screwing the economy. The nominal rates are screwing the debt side. The economy is going nowhere. They can't actually attack inflation because they would bring about a credit crisis if they did so. Now, this is going to be the big, big dilemma that I think people are going to become increasingly aware of when it comes to the dollar over the course of this year. Now, that dilemma was precisely the situation we saw in the 1970s, before this run-up, if you like, to the Volcker appointment. And it was Paul Volcker who raised the prime rate in those days. It was the prime rate that everybody followed, up to 20.5% to kill the inflationary expectations. Now, in those days, what that did was it wiped out the savings and loan business, which, it was all sort of picked up and so on. What are they going to do this time? You don't really have the option to go down the Volcker route to kill inflation because of this massive quantity of debt. And not only that, but if you're going to push up interest rates in the dollar, then you're going to create the crisis. And we're already seeing the strains in emerging markets because those currencies have done exactly the same thing. I'm not including China in the emerging markets in this sense, but if you look at some of the emerging markets around Latin America, and we've seen the problems coming up in the Argentine, I would also suggest that some of the Southeast Asian countries have been too profligate, if you like, in their currency production. And so you can see that there is this danger, if you like, of a fiat currency problem coming up, which because nobody will be able to tackle the inflationary consequences of earlier monetary stimulus. And under those circumstances, the dollar will go down, gold will go up. That's what happened in the 70s. I see it happening again.
Now, one of the kind of solutions a central bank could implement is just, raise the inflation target. And it seems like you commented on this about how Canada seems to be doing this.
Well, they're not doing it yet, but what we have seen is that some of the Bank of Canada's economists have written an article which they published at the Bank of International Settlements website, suggesting that one solution to the current problem, because central banks are worried, they've got no room, really. They would like to have interest rates a bit higher, but they don't know how they can do that without creating a credit crisis. They expect a credit crisis will occur at some stage, and so therefore they need the room to be able to lower interest rates in order to respond to that credit crisis. Now, one of the things that these Canadian economists were looking at was, well, what happens if we raise the target rate of inflation? Will that give us more headroom with this problem? And the whole thing is actually laughable. It's all based on the idea that you need inflation to stimulate an economy. Now, if that was true, then 4% would be better than 2%. 100% would be better than 4%. It's just not true. We don't go out into the supermarket, say, and buy things because they are more expensive. No, we look for the bargains. I don't know, how it is that economists have got this idea in their head that you've got to continue to drive up prices in order to create demand. You don't. Actually, what they're doing is they're driving up prices to lower or reduce the cost of labor. That is actually what they're trying to do, and they're being entirely dishonest about it. And they now have the problem that inflation is running out of control. So what do? Well, let's see if we can change the targets. That's going to give us a little bit more of a leeway. And I suspect that this work is a bad word for it. If this suggestion from the Bank of Canada's economists gets more traction, I can see that other central banks are going to also explore the possibility. And this also is one reason why they're really pushing the possibility of doing away with cash altogether, because the other way to do it is to put in negative interest rates so deeply negative that, from their sort of straight line graph, they can say, well, if we reduced interest rates to stimulate the economy and get inflation back up, then if we can, if we're not bound by the lower bound and we can actually push inflation way below the lower bound, then surely that's going to be a good thing. It's not. It's a tax on deposits. But anyway, that's another subject.
All right. Well, Alasdair MacLeod, it's really been a pleasure to have you on today. Before we let you go, did you want to share with the viewers any last thoughts you had and where they can find you online?
Well, you can find me at goldmoney.com. And if you go onto the landing page, hit the research tab, and under there's insights. And I write an insight article, which is published sort of, I suppose, midday to late afternoon EST on Thursdays. And I also do a market report around about the same time, but on Friday. And that's another weekly thing. So that's where you'll find me.
All right. Once again, thank you so much for your time today.
That was my pleasure.